Morning, everyone. Thanks for joining us for today's Research Morning Call. Today we have AMD's initiation as well as an update on PanU. And for the technical analysis section, we have the S&P 500 and market trend analysis topic 6. And for the macro and sector outlook, we have FANGM for June 23, as well as the usual Singapore Weekly for week 28. So without any further delay, let me hand over the time now to Max to speak about AMD. Max, please. Thanks.
Thanks, Darren, and good morning, everyone. We just published our initiation report on AMD with the report titled More Market Share Gains Expected. Next slide, please. Yep, so just as a background, AMD designs and sells CPUs and GPUs, but they also provide other components that we may be less familiar with, such as FPGAs, as well as any other semi-custom system on a chips or SoCs. So these components produced by AMDs are used in consumer PCs or any other consumer PCs, servers in data centers, or any other electronic devices outside from the PCs as well, excluding smartphones, of course. And they are also used in gaming consoles as well as embedded devices. So when we talk about embedded devices, it is something that runs on their own power supply, such as the infotainment system in a car or the industrial machines, digital signage on the road, as well as the medical equipment. So if I may shift your attention to the right-hand side, you can see that the product lineup of AMD. So on the top row is the products that we are most familiar with, which is the consumer PC CPU as well as the GPU. The middle one is the one that is used in the servers in data centers. And then on the bottom row is the FPGAs as well as the semi-custom SoCs that are used in the embedded devices I mentioned before. So just for information, FPGA stands for Field Programmable Gate Arrays. And they are essentially a chip that can be reprogrammed for the user, whose users can be reprogrammed even after they are produced. So if a customer has a very specific task in mind that they want the chip to tackle in their systems, then FPGA is the answer. And if they want to change the usage of the chips, they can able to do so if they are able to program it right, which can be highly efficient. Next slide. Yeah, so in terms of the revenue model, AMD reports its business into 4 segments, namely data center, client, gaming, and embedded. So for data center, as the name suggests, they sell the CPU, GPU, FPGAs for use in servers in data centers. And then for client, it's essentially the business that sells the consumer PC CPUs that we normally purchase. And then for gaming, it also sells the consumer GPUs that are used for rendering high quality graphics for gaming purposes. And then inside this segment, they also sells the semi-custom chips that are used in gaming consoles, such as your Sony's PlayStation, Microsoft Xbox, and even the Steam Deck. And then for embedded, as I mentioned just now as well, they sell all of these components for these embedded devices, and typically they also have, but the main difference is that typically they are less powerful because these devices run on limited power supply, and they run on a long periods of time, so they need to emphasize on efficiency. Yeah, so in terms of revenue distribution, FY22 was quite a unique year for AMD, as it is quite evenly spread out across the 4 segments, with data center and client being tied at 26% of the total revenue. And gaming surprisingly makes up the largest because the continued strong demand for the latest Sony PlayStation 5. And then the unique thing about this last year is that embedded makes up about 19% of the total revenue. Before that, the embedded actually just made up about only 1% of the total. So yeah, for the revenue in 2022, they achieved the revenue of $23.6 billion, which signifies a 44% year-on-year growth. And this is mainly driven by the jump in data center revenue, which grew by 64%. Client revenue was down 10% because the PC market experienced a challenging year, the challenging second half of last year. And gaming was up by 21%, mainly driven by the continued strong demand for the semi-custom SoCs in the PlayStation 5. And then, as I said, embedded was a unique year in last year because they include the revenue from the acquired companies in 2022, which caused the embedded segment to jump by about more than 17 times. In terms of PATMI, the company recorded a PATMI of $1.3 billion last year, and this is a decline compared to FY21, despite the revenue growing by 44%. This is mainly because AMD incurred a 3.5 billion acquisition-related amortization, and it also assumes the operating expenses of the two companies that they acquired, which are Xilinx and Pensando. So this caused the operating expenses to jump to more than double year on year, which far outpaced the revenue growth, causing the PATMI to experience a decline. Next slide. Yeah. So now moving on to the investment highlights. So firstly is that we see tailwind from generative AI for AMD. So AMD has gained significant presence in the data center CPU market as it has increased its market share from just 4% in 2017 to about 20% in 2022. And this increasing market share is because of the product's superior power efficiency compared to those of its competitors. And this is evidenced by the fact that its EPYC CPUs, which are used in servers, powers about 228 of the world's top 500 supercomputers as of June of this year. And this is a huge jump compared to just 2 in 2017. And the EPYC CPUs also powers 15 of the top 20 most energy efficient systems in the world. And so we think that the increasing adoption of generative AI will expand the server demand for servers, which will ultimately benefit AMD as well, because this would mean that there will be a boost in CPU demand as well. And furthermore, we think that AMD will be able to further increase its market share in the data center CPU market, because more workloads are getting migrated over to systems that are based on AMD. However, AMD is still underrepresented in the data center GPU market, as it only holds about 8% share. And this is a significantly lower share compared to the largest incumbent, who holds about more than 90% share. Despite this, we think that there is an opportunity for AMD to raise their presence in the data center GPU market, as we believe customers are more than likely to look for a second source supplier to mitigate the risk of over-relying on the main player, as well as the extended lead time given the rapid adoption of generative AI now. Yeah, then moving on to the second highlight is that we see a potential for margins expansion. So AMD has been able to increase its gross margin from 34% in FY17 to a higher level of 48% in FY21. And AMD was able to maintain a gross margin at 45% in FY22, despite incurring a $1.4 billion amortization charge related to the acquisitions as part of its cost of sales. And this is also despite the fact that the company experienced a margin contraction in its client business last year. So we expect gross margin for FY23 to expand as AMD sells more of its data center and embedded product, and the products in these segments are higher margin in nature. Furthermore, the increasing adoption of the company's latest AMD EPYC CPUs will also help boost the margins, because we believe this latest generation has a 50% higher ASPs compared to the last generations. In terms of net margins, FY22 net margins dropped to 6%, and this is mainly because of the integration with Xilinx, as I mentioned just now, as well as the decline in client revenue. So we expect this. So unfortunately, this expenses is going to continue as they all operate under one entity. But we think that net margin is going to expand moving forward as they achieve high operating leverage and the recovery in client demand. Next slide. Yeah. So for the third point is that there's a strong AMD has a strong intellectual property portfolio enabling flexibility. So just to give everyone a brief background, analysts are worried that the conventional x86 CPUs produced by AMD and Intel are going to get displaced by the CPUs based on the ARM architecture. And we can see some examples of this happening, such as Apple opting for making its own CPUs, which are the M1 and M2. They are based on ARM CPUs, and they decided to not use Intel CPUs anymore. So this is also a concern for AMD, but AMD has indicated that it has a suite of IP that enables it to design semi-custom chips, including CPUs that are based on ARM design. So we think that this mitigates the risk of AMD's products being fully displaced by the ARM counterparts. And furthermore, the acquisition of Xilinx also broadened the company's product portfolio in adaptive computing, which we see as the enhancement on their expertise to provide more optimized solutions down the road. Next slide. Yeah, so in terms of risk, AMD is a fabless company, so which is why they rely on TSMC to produce the chips. So because of this, we think that their product advancement depends heavily on TSMC's ability to improve and sustain their technological superiority. Furthermore, because they rely on TSMC, we think there's also a possibility of supplier concentration risk, which means that AMD will be adversely affected if TSMC faces operating headwinds or loses its competitive advantage in the future. Then for the second risk is that the increasing tension between US and China. So AMD although AMD doesn't disclose the specific amount of the business exposure to China, international sales makes up about 70% of its total revenue. So because of this significant international exposure, we think the escalating the geopolitical tension between the two countries will cause significant uncertainties in AMD's ability to maintain its business in China. Yeah, so lastly, in our valuation, we initiate coverage on AMD with a cumulative rating and a target price of $125. And this is based on our DCF valuation with a WACC assumption of 7.4% and terminal growth rate of 3.5%. That's all for AMD. I hand over my time to Jonathan to run through FANGM monthly.
Okay, thanks, Max. Good morning, everyone. So I'll just be running through the FANGM monthly for June. We issued a report this morning titled "The Re-rating Driving Most of the Gains." So we just briefly look at the performance for last month. FANGM was up 5.6% in June, and that was actually a slight laggard compared to the Nasdaq and S&P, which both gained about 6.5%. Netflix was a top gainer, up almost 12% on some positive subscriber growth news, while Alphabet was the main laggard, down slightly more than 2%. In terms of the first half performance for this year, the FANGM was up almost 49%, far outpacing the Nasdaq and the S&P 500, which was up 39% and 16%, respectively. So this 49%, has actually been the best performance over the last 10 years. So it's more than double its previous high of 24%, which was set in the first half of 2020, which basically was initial stages of the COVID rebound, and it's also more than three and a half times more than its 10-year average of 13% for the first half of any year. So we think that most of these gains have been driven by two factors. The first, earlier on in the year, was cost-cutting initiatives by a lot of the FANGM companies, especially Meta and Alphabet. And these were aimed at, I guess, margin expansion over the long run as a lot of these companies look to lean out and become more efficient. The second factor was an AI-driven hype, which we saw towards the end of the second half, towards the middle of the second quarter for this year, which is expected to boost productivity and revenue growth for the FANGM in the immediate term. So surprisingly, what we actually saw was also that the earnings for a lot of these FANGM stocks didn't really change much. So some of them got a positive movement, I guess positive change for this year by about 2 to 5%. Aside from Meta, which had the largest earnings revision to the upside because they cut off so many people. And so we think that the share price performance has largely been a result of multiple expansion. If you look at the FANGM forward PE, this has increased from 24 times at the beginning of the year to about 33 times this year. So that's like a 30, 35, 40% increase in terms of just multiple expansion. And so on the macro front, we also still see the current environment is fairly uncertain. Interest rates remain relatively high, and we still see some near-term weakness in demand for tech goods like smartphones and personal computers. Moving on to the next slide, where we review the individual news for some of the companies. We'll start with Meta. So they actually announced their newest Quest 3 VR headset at a starting price of $499 for their 128 gigabyte version. This new Quest headset will come with the next-gen Snapdragon chip from Qualcomm, which is expected to increase their graphics by at least 2 times compared to the previous Snapdragon chip. Meta also introduced a new generative AI model called VoiceBox. So this text-to-speech model is supposedly able to help with audio editing, sampling, and styling, with capabilities that are able to produce high-quality audio in several different languages. So essentially, you could just type a sentence or paragraph in text, and this AI model will be able to read out this text in a specific language, in a specific way to sound very I guess human-like. And I guess the idea for this is that in the future, with new iterations of this kind of technology, they'll be able to improve a lot of your virtual assistants to make them sound a little bit more human-like. Or also in terms of like real-world use cases, you'll also be able to help I guess visually impaired people into hearing voice notes that actually sound a little bit more either like their friends or a little bit more human-like, I guess. So that's all of the news for Meta. In terms of news for Alphabet, they're looking to move some of their manufacturing of their Pixel products into India, so away from China. This is similar to what Apple has been doing for the last year or so. As more and more companies kind of worry and they take note or they're taking note of what actually happened during the pandemic when there were a lot of shutdowns in China, which really affected a lot of supply chains for these companies. So this kind of coincides with India's PM Modi and his visit to the US, where he met quite a number of CEOs from your FANGM companies like Tim Cook and Satya Nadella from Microsoft, as well as Sundar Pichai from Alphabet. And what India is actually pitching is that they're going to be an alternative kind of production hub, manufacturing hub, where companies can actually move to instead of putting their money into China. India also has a lot of production-linked financial incentives for these companies to kind of shift over. So we do think that as an alternative, it does make sense for a lot of these larger companies to slowly shift their production out of China and into India. In terms of a product fit for Alphabet, it also kind of makes sense because you do by manufacturing your products there, you also do have significantly better access to the market there, which in India is one of the largest markets in the world, and so it would be something that Alphabet could look at to leverage. In terms of Netflix, Netflix actually saw a spike in new subscribers after its password crackdown in the US. So the company actually saw average daily signups hit about 73,000, which is more than double its prior 60-day average. And it's also exceeded the initial pandemic sign-up period, where everyone was stuck at home, and there were a lot of signups for new Netflix accounts. So we do think that this is the main news driver and something that really drove share price performance, because this was only kind of initiated towards the end of May, early June, and investors expect new signups to continue at least for the rest of the year. Secondly, there's actually an actors, I guess there's a potential strike by the actors. So they're following in the footsteps of the writers, which actually went on strike in May as well. Similar to the writers, they're actually aiming for higher base compensation from major studios, as well as safeguards around the use of AI. I guess the main worry here is that AI will be able to displace actors in terms of a studio using AI to kind of depict and to totally replace a physical actor. You can use AI to generate actors' kind of walking style, as well as speech and all that, and just totally not use an actor for production. And so this is something that I think is quite important in Hollywood right now. It's the biggest drama that is going on, and has been going on for the last few months. In terms of streaming rebounded as a percentage of total US TV time. So right now it's at 36.4%, up 2.4% month-on-month from the prior month. So that's all for Meta, Netflix, and Alphabet. I hand it over to Max for Apple and Amazon. Thank you.
Yeah, thanks, John. Hi again, everyone. So I'll start off with Apple. I guess the major news for Apple for the month is that it unveiled the new Vision Pro headset in WWDC. So the Vision Pro is Apple's first major new product in a decade after the Apple Watch. So essentially what Vision Pro does is that it allows the users to have a virtual reality experience whereby the apps are overlaid on the physical world to your surroundings. So this headset can be used to watch your movies or act as a monitor when you connect it to the Mac, but without actually having the physical monitor there. So it's just like it just looks like it is floating there in front of your surroundings. Uh, the Vision Pro is used the new thing about Vision Pro is that it is controlled using your eyes, hands, and voice. So if you want to select an app, you just use your eye to eyeball it, and when you want to select or tap onto something, you just pinch your fingers. And this is enabled because the device is equipped with a lot of cameras and sensors as well as microphones. Apple says that the device will cost about $3,500 and it will be available early next year. So in terms of our thoughts, we think the Vision Pro will not be a significant revenue contributor in FY22. And this is mainly because we believe there will only be a small limited number of customers who are willing to buy the device because of the high price tag. And then we also think that instead of being a revenue growth driver, we think the launch is intended to to establish a stronger supply chain, as well as a pool of developers so that they can enhance the user experience for the subsequent generations of the product. Yeah, then moving on to Amazon, the first news is that Amazon is set to be planning for an ad-supported tier for its Prime Video. So Amazon is reportedly discussing some alternatives to introduce advertisements in their Prime Video service. And one of the ways that they are considering is to bring advertising to existing subscribers and then giving them the options to upgrade to a more premium tier where there is ad-free and there are more features. However, Amazon has not finalized the plan yet, and they could actually decide to abort the initiative altogether. And then for the second news is that Amazon is getting sued again by FTC, and this time it's on their Prime sign-ups. So the FTC alleges that Amazon enrolled customers into their Prime subscription without their consent, and they actually made it difficult for the customers to cancel. The agency said that the company used a quote manipulative, coercive, deceptive user interface designed to dupe customers to automatically renewing the subscription. And the FTC is actually seeking monetary civil penalties, but they haven't specified the amount yet. So the plan for offering an ad-supported tier for Prime Video is actually similar to what Netflix and Disney has done recently, and we believe this should provide Amazon a further potential for margin expansion on their retail segment, given the high nature of advertising business. And we also believe that should Amazon offer such a service, they will see a high level of interest from advertisers, given the fact that their advertising business continues to show strong growth over the past few quarters, despite the fact that their competitors are facing growth moderation or decline. And then in terms of the lawsuit from FTC, we think it won't have a significant impact on Amazon's financials in the near term, because such lawsuits typically take years before the court finally arrives at a verdict. So yeah, that's all for me. I hand over the time to Ambrish to talk about Microsoft. Thanks.
Thank you, Max, and good morning, everyone. So moving on to Microsoft, in June, Microsoft announced a quarterly dividend payout of 68 cents per share, and this is in line with the previous quarter. The dividend would be payable on September 14 to the shareholders as of record as of August 17, and the ex-dividend date is August 16. So this suggests that if an investor purchased Microsoft stock on or after August 16, he might not receive the quarterly dividend payout. So overall, to reiterate our investment thesis for Microsoft,
will not be good, but at the same time.
Hello, Max. I think thank you. So to reiterate our investment thesis for Microsoft, we believe that cloud computing, it's Azure segment, it would be the long-term growth driver, mainly because as the companies that digitize their operations, and Azure, it's the fastest growing cloud product as compared to Amazon's AWS and Google Cloud. So for the June ended quarter, Microsoft believes that Azure revenue, it should grow by about 27% year on year. Although the Azure consumption, it's declining over the last couple of quarters, mainly because of macro issues. And the Office 365 commercial revenue expected to grow by about 16% year on year. Meanwhile, Microsoft, in the near term, it's expected to be impacted by the weak demand for personal computers, laptops mainly, and this should impact its Windows OEM revenue, and it's expected to fall by about low to mid 20% range. So Windows OEM revenue, it's basically the Microsoft generates from the PC manufacturers like Dell or Intel who install Windows on their operating machines. So overall for Microsoft, we have downgraded it to neutral from accumulate, and mainly because of its recent share price performance. However, our target price remains unchanged at $328. Next slide, please. So to conclude, we remain neutral on FANGM mainly because of two reasons. As John mentioned, that the 49% surge in the first half of 2023, it was mainly because of AI-driven hype and the cost-cutting initiatives like layoffs, and not it was not mainly instead of positive earnings revisions. And secondly, in the near term, there is weak demand continued with respect to smartphone sales and personal computers, as well as the moderating trend should continue for cloud. So that's all for FANGM. I would now like to pass on to Peggy for Pan United.
Thank you, Ambrish. Good morning, everyone. I'll talk about Pan United Corporation this morning. This is an update report. We are introducing the FY24 earnings estimates for the company. Can I have the next slide, please? Thanks. Thank you. Okay, Lisa's recommendation is still a buy. Our target price is reduced from 54 cents to 50 cents. This is derived based on a discounted cash flow methodology. Well, a few things to note for Pan United. They are the market leader for ready-mix concrete. Short form, we call it RMC. In Singapore, they had about 40% market share in Singapore market. Looking across the industry contract awards for the first 4 months of this year, that has dropped by 13.5% year on year. So which leads us to think that in second half of this year and probably first half of next year, the progress, the amount of work, construction work being carried out will be slower, and also means less demand for RMC. And then also in the first 3 months of this year, the consumption of RMC has declined 4.5% in terms of volume. Okay. But longer term, looking out into FY24, it will be lifted by the ramp up in the government land sales program. For second half of this year, the government is aggressively pushing out the GLS units for private housing. That is about 9,250 units for the whole of 2023. This is 50% higher than last year. The contracts for this will probably be awarded in first half of 24 after the tender complete in this year. And then that will translate into orders from second half of next year onwards. Okay. Another positive about Pan United is that they have some low carbon concrete solutions that are gaining adoption, especially among the GLCs. For instance, PSA and the Capital Land Group, they are asking for some of these solutions in the construction projects. And then with more greater adoption, they will set PanU apart from the rest of its competitors. So RMC, the concrete is no longer a homogeneous product. There's some differentiation here as developers and contractors opt for some greener solution. So potentially PanU will be potentially could be a candidate for any ESG funds, ESG focused funds. Okay, so we are maintaining a buy call because the company is really very cash generative in their operation. Even during the pandemic years, they have been able to generate about 9 cents, 9 cents per share from the free cash flow, from the cash flow from operation. So we think this will be able to underpin the continued dividend payout, a very strong payout that gives a yield of at least 4.5%. The revenue growth you see this year for and next year for, especially this year for PanU will mostly be driven by the higher average selling price. Can we have the next slide, please? Thanks. Okay, this is what I mentioned earlier. Is in chart in graphic form. Contract awarded last year was already down year on year, but first 5 months of this year it dropped further by 13%. And construction costs is continue to climb, so that is bad news for construction companies and also for developers. Compared to pre-pandemic year in 2019, construction costs have actually gone up by about 35%. Next slide, please. Thanks. In terms of industry consumption of ready-mix concrete, that has dropped in the first 3 months of this year. Last year was already a decline, and the selling prices has escalated since pandemic happened, mainly due to higher cost of the cement and sand, and also the freight cost as well. And but that higher ASP is plateauing now, and so it's almost reached 0% growth year on year compared to May last year. So therefore, our call for PanU is a buy at the target price of 50 cents. I hand you over to Zane for the technicals. Thank you.
Thanks, Peggy. Good morning, everyone. Now move on to the technicals. So first up for S&P 500, last week we had a retest of the recent 4,450 swing high level. And look at the chart wise, it looks to be a possible island top for now. And currently, there was a retest on Friday to fill the gap, but it was met with rejection as well, and we closed lower. So with that, currently, I think some potential short-term bearish momentum in the S&P. We could potentially retest the recent swing lows around 4,330 for some support. So in the short term, S&P could be moving in a bit of a range consolidation for the time being. For the resistance wise, it's likely to be at 4,450 to about 4,520, and support wise is around 4,330 to about 4,380 currently. Next slide. So we covered in our market trend analysis topic 6, the relationship between the annual changes in US M2 money supply as well as S&P 500 over these past 2 decades. So it's titled there's a very little relationship between these two. So when you look at the M2 money supply, which actually consists of some of the components are actually cash, your checking deposits, money market funds, as well as government bonds held by individuals. So all these money supply is actually down 0.88% over the past year, which is actually a very rare decline when you look at the data across the past 2 decades, since that every year was actually green except for last year. And in terms of the relationship between these two, you can see that mostly there's generally a positive relationship. Most of the time, you see both of them being green for the year, except a few times, around 4 to 5 times, we see S&P is actually down or flat throughout these 20 years. Next slide. Then when you look at when you scrutinize the relationship in terms of the percentage change for annually for these two variables, you can see that the general positive relationship is quite well reflected. So both of them is usually both positive or negative in the same year. But however, when you look at it in terms of the variation or the percentage of change, actually quite varies quite significantly. So you can't say that because money supply actually increased by how many percent, then S&P will increase by a similar percentage in a certain year. So you can see not much of a very close relationship between these two variables. Next slide. So in general, positive relationship between these two, as mentioned, S&P gained in 15 of the last 19 instances where M2 rose annually. So that's about 78%. In terms of the annual change wise, M2 was rising about 6% every year, while S&P was about 9%. However, when you looked at the strength of the relationship using some of the statistical terms like correlation coefficient, is only 0.15%. So that's actually very low. Sorry, 0.15. Yeah, so 0 means there's no correlation between these two, while 1 is a perfect correlation and -1 is a negative correlation. Then in terms of the coefficient of determination, which is more commonly known as R squared, it's only 0.02. So it means that it measures how much a variable can change in terms of the another variable. So when you look at the annual change in M2, was only able to predict just 0.2% of the changes in S&P 500. So there's a very little relationship between these two. So when you look at this year wise, S&P is up about 14%, while M2 was actually declining about close to 2% year to date. So in conclusion, investors should still look at many other factors such as GDP, unemployment data, which also influence the S&P 500's performance. So that's all from me for now. I'll pass on the time to Paul to talk about Singapore weekly. Thank you.
Thanks, Zin. So I'll move on to the usual, some of the key macro news that came out for Singapore. We had the PMI number continues to be weak. I think electronics especially is the lowest in almost 3 years. We also had some retail sales from Singapore, also weak. It's slowed down to around 1.8 or 2% year on year in May compared to 4%. So it's sliding back to pre-pandemic. Our retail sales in Singapore pre-pandemic is usually at around 1% or 0.7%. Yes. So slowing back to that. If you want to know what's doing well, dining and apparel is the fastest growing segment. In terms of a property price index that was released by URA for private residential, we're starting to see the first decline month on month. Quarter on quarter, sorry. And also it's up about 7.2% year on year. So it also shows that I guess there's less risk of cooling measures, because usually when it hits double digit, that's when the risk of intervention. HDB prices continue to be strong. Resale prices is up 1.4% quarter on quarter, sorry, not month on month. The other strong data point is tourist arrivals coming into Singapore. So we had like 1.129 million. We doubled from a year ago because of the reopening. But this is the record high month post-pandemic. In terms of some exports global numbers that came out from Korea and Taiwan exports, we still see a very weak external environment. What we see is that the Korean exports continue to decline 6% and Taiwan 23%. So they are on their 9th and 10th month of contraction. Taiwan's a bit accelerating, but I mean Korean a bit at a slower pace. There was some news on the Fed minutes just to some heads up. This was the Fed minutes on the recent June meeting. So basically all the participants basically agree that there should be more additional increase in the Fed funds rate. So what they say is basically that there should be more interest rate hikes in 2023. And the mild recession here is basically the staff comments. So they still think there's going to be a mild recession in the US later this year. The big number that came out from the US is the payrolls or jobs. It was slightly below expectations, but but again, compared to the pandemic, it's still above the pre-pandemic average of about 180,000. The segment that is doing well is actually the segment that is hiring a lot is actually government and education and healthcare. So these are the least sensitive to the economy. So this could also mean that payroll additions in the US continue to be strong. This is important. So it also means that unlikely that the Fed will cut if they continue to see job growth remaining strong. Next slide. So in terms of a tactical view, we see more pressure on equities. I think with another rate hike coming out on the 24th of July, and with labor slack. So why we still think it's almost of course the market is pricing in almost 90% that there'll be a rate hike in the 24th July Federal Reserve meeting or FOMC. Firstly, labor slack is still very high. This is the Powell's favorite measure. I mean, this is a bit more of an economist talking here, but now they like to look at vacancy. That means the amount of vacant jobs compared to unemployed. So there's like 1.6 jobs for every one person looking for jobs. So this is higher, and he likes to look at this barometer, not just the unemployment rate. Another reason why, although the job numbers was weak, but on a 3-month moving average is still 244,000, higher than pre-pandemic. So what we also see the pressures that the 10-year bond yields in developed countries are all rising back to the 2023 highs. So why we say that there's more pressure on equities means that growth is slowing, but at the same time interest rate is climbing up. So we're gonna both will pressure on valuations and of course earnings. In terms of some of the sweet and soft spots that we see in Singapore, retail sales is weak, like we mentioned, is trending back down to pre-pandemic. So this will be negative, I guess, or discouraging for retail REITs and also supermarkets. Tourism is still positive, is still performing really well, double from a year ago, and it's of course positive for hospitality REITs. For property, the resilient HDB prices, there was just announced that the resale price will only continue to support the upgraders market. So we saw some launches that came up last week, the most recent weekend, 50% take up at Lentor and almost 30% for CDL's Miss. I guess the lower take up for Miss is maybe the pricing is a bit more aggressive compared to the nearby surrounding areas. So in terms of the key events to watch, will be the US CPI. So this is of course a very big number. Any gap down or, but we think if any major surprise in this will actually dictate market direction. So it's a very important barometer or indicator. Then on Friday, all the US banks will be releasing their results. These are some of the webinars coming up. So we have our usual strategy and stock picks for US on the 13th of July. Then on Saturday will be the Singapore strategy. Next slide. So just a graphic illustration of some of the events. So as the title suggests, domestic demand is starting to slide. So you can, this is represented by the retail sales. You see in Singapore, it continues to slide quite sharply, the blue line. Of course, there's a pandemic reopening effect, but it's now sliding to almost 2%, coming close to the pre-pandemic. And with the June holidays coming, it could slide even further. The one encouraging data for Singapore is the tourist arrivals continue to climb to new highs since the pandemic began, about for June, 1.12 million. Next slide. Then this is just to show, I know it's a bit small, sorry for that, but this is the table on the chart on the left is basically the private residential price. So this is the blue line. You see all these red, green comments are basically the cooling measure. So as in May when they raised the ABSD, sorry, it's very small here, but you can see that before it raised, the property price went up about 11%. And then the previous time the authorities raised or imposed a cooling measures was in December 21. And again, usually the property price runs are almost 11%. So I guess if you use both these data points, it means that anytime you hit 11%, the red flags are out that they will impose cooling measures. The positive is HDB prices. So if you look at this table, so if you look at the last 4 years, when the last time we had such a strong run in HDB prices, which were the almost post global financial crisis from 2007 to 2013. But if you let's take the last 4 years, the property price in HDB resale was up almost 10% a year. And I think the recent run is almost just as bullish as the 2013 kind of rally. It was up almost 8%. So or 7.7% a year. You see the CAGR here. So in a way, I mean, if you do the rule of 72, what it means is that HDB prices could actually theoretically double every 10 years. I mean, this is just maths. Of course, it doesn't mean the pace will be the same, but this if they continues to climb at this rate. And actually, HDB resale price is actually outpacing even the private. If you use 4 years, because private resale 4 years is up 6.5, but HDB is up 7.7. The only takeaway from this is that this will continue to keep the upgraders market. I don't know why they call it upgraders. Just HDB deciding to buy private. So that should, as they sell and then they have a huge windfall or gains, and then they will move into private. I mean, that's the hope, I guess. Yeah. Next slide. The next is just an illustration of the US jobs. So what Powell likes to look at, Jerome Powell, is the blue line here. So this is the vacancy. That means the amount of available jobs. It continues to be almost 10 million vacant jobs compared to pre-pandemic 6 million. So this is just a reflection of this. Although the unemployment rate is low, but another indicator that shows the labor is still there's still a bit of shortage is this blue line, which he likes to look at. Then I won't run to this, but anyway, it just shows that what we think is the payrolls is just replenishing, because it only went back to pre-pandemic in June, but we'll discuss it more in the strategy and stock picks. Next slide. Okay, and because since MES was in the news, so we just wanted to look at the reserves. They just came out last week. So the FX reserves for Singapore continues to be really strong. So the blue line is our FX reserves, and the red line is just the change, the cumulative 12-month change. So you notice the blue line collapsed quite significantly in 2022. So if you look at the numbers here, you will notice that the FX actually dropped $128 billion US, but actually 54 billion of it actually went to the government. You call it reserve management government securities. So MAS will transfer 54 billion US to authorities or to JIC to manage. That's why the reserves. Then it was even larger in March 23, the most recent annual report. It was almost 136 billion. So you just add back both, just for illustration, our FX reserve could actually hit almost 500 billion. Compared to pre-pandemic, I think our pre-pandemic was about February 20, we look about almost only about 280 billion. So our FX reserve almost jumped by 220 billion over since the pandemic. And you can see that the reserves really spiked up when the pandemic happened. So there's a huge amount of liquidity that came into Singapore, but it didn't go to Singapore equities. But anyway, just for understanding purposes. Next slide. Okay, this is just our last one. Why we think equities could also be under pressure, because you can see that bond yields continue to rise. An illustration, if you focus on the red line, UK interest rates, it started to peak maybe in end 2022, then it dropped down. But the last 1-2 months, you can see that bond prices continue to surge up. Even in the US, it's actually hitting the 10-year bond yields are actually at the record high for the year, and of course, it's coming back to it's going to new highs at the bond prices. You see that also in Germany, except in Japan, because it's controlled anyway. So what it means is that it will just put more pressure on valuations if this continues to rise. Okay, I think with that should be the last. I think we'll move on to Q&A. Thanks.
Okay, I'll take there are a couple of questions here for the US side. There's one here. Can Jonathan do some EV counters? I think EV is good. And the second one, I guess, follow up to that is maybe on the way also do some other industrial stocks. Yeah, so if you tune, we're actually going to have our third quarter strategy and stock pick this Thursday evening. If you tune in, we'll be sharing a little bit more on some EV, not counter specific because we don't cover it as of yet, but we'll do just a very brief. We'll just touch on the EV industry quite briefly. And then following that, I'll also be doing another webinar, I believe on the 27th of July. We'll do a deeper dive into the EV industry. So we'll kind of strip it down to some of its parts. So feel free to tune in there. Hopefully we'll be able to give you some answers over there. I think that's all from myself. I'll hand it back to the rest of my colleagues. Thank you.
Okay, I'll take on the question. Can we see many hi Peggy's? Yeah. Okay, let me just read out the question. This question is, hi Peggy, what is the market share of PanU in the RMC industry? Is BRC Asia a competitor? PanU versus BRC Asia, which is a better buy? Pan United has a 40% share in the RMC market in Singapore. Yes, they are the biggest, the market leader. BRC is into more into steel products, mainly the rebars. That's for also construction work. So they are both in the construction industry, but the products are very different. Okay. The first PanU versus BRC. Okay. For the RMC sector or for cement sector in particular, the competitive advantage is the silos at the ports that they own. Okay, so there's limited space in the port. So whoever has the silos will be able to bring in the import cement into the country. So you can only have so many players. So at the moment it's about 3 players in the industry. So for steel products, they come through the freight, sea freight, so the vessels. Of course, BRC is also a big player here. I think estimate they have about 70 to 80% market share for steel rebars. And whenever a vessel comes in with all the steel bars, they will take the bulk of the cargoes from the vessels, and the rest will be distributed to the other players like HG Metal and so on. So between the two, we think PanU is a better proxy to play the upcycle in the construction sector, especially when the Singapore economy is not doing as well. The construction sector is always the sector that has been used to pump prime the growth. Yeah, so we think construction will still do well, but steel is different economics totally, because steel prices are still dependent on mostly quite dependent on what China is doing. So when the China demand is up, the steel prices will rise. But when China right now, when the property sector in China is not doing well, the prices of steel will be depressed. So we are concerned about the decline in the steel prices, because if they are not managed properly, they might be caught in a situation where the PRC might be holding high cost inventory in their books. The other thing about PRC right now, although we have a positive call on PRC, but there's something that we have to mindful of, is that the HG Metal is also is a competitor in this space, although a smaller one. Has just changed the shareholding structure. They have a new shareholders, probably with deeper pockets, probably also very keen to come in and compete in this space. So both have Chinese shareholders, and yeah, so the competitive landscape might change after this. So between the two, we think PanU is a stronger story. Thank you. The second question also on PanU. Hi Peggy, is PanU able to have pricing power over its customers, i.e. increased price and demand is inelastic? This one, I guess the answer is probably not so, no, right? Because the biggest buyer is the Singapore government with all the infrastructure projects, and pricing is very transparent. RMC is made up, is 1 part cement, 2 part water, and 4 parts aggregates. So it's not about pricing. For these players, it's about how they are able to control costs. So having a bigger volume will help them in terms of cost management. Price is probably very, very transparent. All the industry players command about the same price. Hi Peggy, those charts you show for PanU do not appear to be rosy, but why is your recommendation still a buy? Yeah, this is a good observation. Yeah, I'm trying to use the chart to point to the fact, to the reason why I cut the numbers for FY23 by 20%, because the volumes that Terence has earlier projected has probably not going to come true according to what the data we've seen from BCA. But having said that, BCA the data is always being revised. So they yeah, what I had was the latest numbers that I got before today. Okay, so the charts definitely show that this year will be a very flat year, FY23, but most of the growth we think will be pushed back to 25-24, because supported by all the government land sales program and the HDB launches, and also the ramp up in the infrastructure work. So we are pointing we're looking towards FY24, and we have a buy because on the discounted cash flow method, the company PanU is really very good in collecting money and very quickly as soon as they contracted a sale. And this also because the industry is very well for building materials. It's has very well constructed rule to say that if you can you certify your work done, you get paid within 21 days. So therefore they are very strong cash flow. That's the reason why we're calling a buy, and the strong cash flow also allows them to be able to pay out a very steady stream of dividend, which beats the T-bill rate right now. Yeah, thanks very much. I hope I answered the question. I pass on to the rest of my colleagues. Thanks.
Hey, thanks, Maggie. Let me take this banking question first before I think I'll pass on to Max. Hold on, where is it? Okay. Yeah. Someone asked a good question. Why do you think the local banks are tanking when they are fundamentally healthy? Yeah. So I think the story that the three local banks have been trying to push for the last few quarters at least is that they have been reaching record net profits and record earnings and so on and so forth. But this is all mainly from the high interest rate environment, which is boosting their net interest margins. But we have been seeing that the Singapore interest rates, which is the SORA, has been flattening for the past few months. And I think people have really investors have priced in the high interest rate environment. So they're not really saying anything new. And also, I guess that's the reason why the price has not been moving so much. And I think also another interesting to note would be let's say for DBS at least, they have mentioned that they are going to be increasing their dividends year on year by around 20%. And they have done it already this year, and they said recently in their investor day that they will be doing the same sort of increase the following year as well in 2024. However, DBS's share price has not really moved much. So I think it's the main thing that is concerning for most people would be that the loans growth has been sort of in the decline for the past few months, which is why the share price has not been moving so much. And I think also what people are trying to see is how the banks sort of how they manage environment where loans growth is very low and the net interest margins start to decline. And I think that the main positive, at least for the banks, would be that fee income is starting to reverse and recover back from the very low base that they had in 2022 and 2022. So that would be one of the big boosts for the banks, but they're not really saying it as much as they should. So I think the people, I think that's one of the main points, that the positives for the local banks at least. Yeah, I hope that answers your question. Thanks. I'll hand it over to the rest of my colleagues. Hold on, sorry, I got one more question. Why is SORA flat when interest rate is rising? And SORA is following if you look at the recent banking monthly, which I did, it's actually following the Fed funds rates quite closely. So the Fed fund rate has been sort of slightly flat the last month, and I think SORA is also it has increased slightly. So I think it's it's really following it quite closely. So I think we'll just have to see again next month if SORA does follow the Fed funds rate and it goes up. Yeah, so I think it's just following the FFR quite closely. Okay, I'll hand it over to the rest of my colleagues. Thanks.
I have another question on PayUnited. I think I just finished it. Hi Peggy, how would you compare PanU and Hong Leong Asia? Which one is better fundamentally? Okay, Hong Leong Asia, in terms of their building materials, that also includes the business, the cement business in the Tasik cement in Malaysia. The building materials only account for 15% of their turnover. The most part of the turnover comes from the diesel engine business, which is the China Yuchai. So comparing the two, I think the Hong Leong Asia, the dividend is a big yawn. And then the free cash flow is still negative. It has been negative for the last 2 years. The the diesel engine business is probably facing is very strongly tied to the infrastructure spending in China and also the property construction activities because of the for the truck. This is like the truck engine, mainly truck diesel engine. So you are Honda Asia is a play. Is the outlook is dependent on China property sector as well as industrial development sector. So therefore, we think probably PanU is still a better play if you for Singapore construction sector and Singapore building materials. Thank you. There's a question on will sets Saturday will be okay. I thought you talked about sets. I'm not sure. I think it should be recorded and shared. Our Saturday strategy and stock pick session for Singapore market this Saturday 10 a.m. It should be recorded and shared. If we did it the last time, I'm not sure, but I think it should be. Thanks. I'll pass it on to Mr. Chew.
Oh yeah, thanks, Peggy. Most of our 11 a.m. meeting is usually recorded, so it's in our YouTube PhillipCapital chat. Okay, we got another question. So let me just run through some questions. I've been in Kiev. Mr. Lai here mentioned I've been in Kiev, Ukraine for 10 days. Battle activities and missile strikes are getting lesser. Which counters will benefit when the war stops in the coming future? Will inflation immediately drop around the world, especially food inflation? Okay, so which benefit specific? I don't have anything specific. Probably be anything related to Europe. I guess that would be the main. I guess would be some of the European REITs or anything touching Europe. That would be the main beneficiary. In terms of the inflation immediately drop, I don't think it will immediately drop because the biggest impact from Ukraine was the Russian and Ukrainian grain, but supply hasn't really been that disrupted. So even though you had the initial spike in wheat and grain prices, the grain prices actually came down. I mean, it actually corrected back. So the supply actually wasn't hugely disrupted, just like the assumption that Russian oil would be disrupted. So that didn't occur. So there might be some near-term decline in agri prices, but I don't think the impact will be that meaningful. Yeah, because if you assume that the supply wasn't that disrupted, but if there really is peace, I mean, the whole market will of course rebound. Then the best will be Europe. I mean, that would be the main one. And the impact to Singapore will be obviously minimal compared to what's going to impact Europe. Hi, Paul. Regarding US Asian hours, so for those who do not know, I think Forums does offer a select number of US stocks that you can trade during Asian hours, which is 9 a.m. to 5 p.m. So the question is, what would you say is the one advantage versus trading during US hours? In terms of fees and charges generally, how do we minimize Sing dollar, US dollar exchange costs? Okay, in terms of the advantage, I think the only one advantage you have is you're I guess front running the US hours, because if there is news coming out in Asia, then if there's news that came out after the market close in the US, which allows you to react compared to ahead of others. I mean, that's my own view. The one big advantage, you can just front run the US investors. So let's say, I don't know, JP Morgan announced very good results after market hours. It's very hard for the rest to react until the pre-market opens about, I think, 4 p.m. So you can actually react earlier at 9 a.m. I mean, my own view. I haven't really seen the actual relationship. So you can basically front run the American investors, I guess, while they're still sleeping, maybe. I'm not sure. I'm just thinking, I've never really seen a case study. I mean, maybe they should have done it, but this is what we think. Then the other thing is in terms of fees and charges, how do we minimize? I'm not particularly familiar with that. Sorry, I don't have the details. On how to minimize that. Yeah, so sorry for that. I'm not the US Asian hours. I don't really not familiar with the fees. Apologies. Can't help you on that. Yeah, maybe you can. We for us we have this talk to Philip of phone number you can actually call to. So you can actually call our help desk and they can maybe help you with the answer. Most of our earnings go into house. If the property price is not so exorbitantly high, more money will be free in our hands to boost overall economy. Yeah, that's true. I think. Yeah, I mean that's true because one thing, the high, not only the property price, the high interest rates is also affecting us. And to boost our local economy, we are also very dependent on the external environment. I think in terms of exports to GDP, I think Singapore ranks the highest. So I think for us, we are a small country, so we are very dependent on external environment and not just the domestic, like you rightly mentioned. Not only property price, the high interest rates also will absorb some of the purchasing power or discretionary spending for Singapore residents or whoever staying here. Thanks for that question. Okay, after that, I think this should be my last one. Then I think she'll hand over to Zain. Mr. Chiu, yeah, thanks. Commented that Singapore resident property doubled almost every 10 years, with aging population, low birth rate, salary not doubling every 10 years. How to afford the high property price? Singapore already the most expensive city. I do not see much upside. Yeah, and anyway, we cannot have much upside. Anything more than 10%, the authority is going to hit us with another cooling measures. But what we do see, the upside is actually, ironically, on the price per square foot, is actually rising also because they're shrinking the size. I mean, that's a fact. The other thing is that we also think that this is my own guess. I mean, because the population numbers is hitting even below the low case. If you recall the white paper, and the infrastructure that we've built in Singapore is 6.8 million. I think ours is now like 5.7. So we can only expect immigration will be the one that will push the property price. That is the unknown, because not that anybody whisper anything to me, but the way the infrastructure has been built, it's more like setting up a larger population here. So that will be the one. And the third factor is also a matter of supply. So I think supply has been unusually hurt very badly the last 2-3 years because of the pandemic. So my own guess is maybe a more sustainable rate is maybe 4 to 5% kind of sustainable rate. And you can't go up anyway. You go up, like I said, whenever it hits 10% or 11% increase in property price, the authorities will come in and just slam down the whole property sector. Yeah. So I think a more stable will be 4 to 5%. Yeah. But what we're just trying to say is that it's not only just the private residential, the HDB is actually the one that is also helping push up the prices. Yeah. In terms of the so-called the move into from HDB to private residential. Okay, let me answer this last one. Hi, Paul. With the Fed expected rate hikes July, will this adversely affect REITs and property developers or even more? I think it will in a certain extent, because what it means is that interest rates continue to climb for the REITs. So so we think this will only be a negative for REITs. For developers, not so bad, because based on the recent take-up rates, I think high interest rates is already a factor. But from what the agents tell us or what the developers tell us, that most buyers, I mean, rightly or wrongly, this is not whether it's logical or not, but rightly or wrongly, they will assume that the impact of higher interest rates doesn't affect them because this is progressive payment. Again, logical or not logical, I think this is for us to have a view. But for new launches, it doesn't seem to affect new launches because you can see the high take-up rate, and because the TOP is only 3 years, so most buyers view it as the impact from higher interest rates is not immediate. Again, it's subjective of whether that's right or wrong. But the impact on REITs is definite. I think the REITs, because they are very dependent on short-term rates, because especially like you mentioned the SORA. So if that although it's stable, but if the rate one more rate hike, we think there could be upward pressure on interest rates. What makes it a bit difficult is that sometimes MAS will intervene to sterilize some of the money. So that's why the correlation, you might see recently, it didn't move out as much because sometimes it could be MAS intervening intervening in the market to inject more liquidity or even to mop out the liquidity. So that is something that affects even our treasury bill sometimes. But it's a negative. I mean, just in a nutshell. Yeah. Okay. I think most of it will be for Zane, but John, there's one Tesla. I'm not sure if you want to. Oh, sorry. This is also for Zane. So I hand it
I think
over
so.
for you, Zane. Oh, sorry. Go ahead. Yeah.
No, yeah, I think that one's for Zane as well, TA.
Okay, Zane, we hand it over to you. By the way, we might want to end it a bit early today at 12:30, mainly because 1 p.m. later we will have our 1 p.m. later we will have our Singapore strategy and stock picks by our Malaysian analysts talking about Malaysian strategy. Yeah, so we might want to end it a little bit early in case anyone wants to join that particular webinar. Thanks. I hand it over to you, Zane. Yeah.
Zaid, sorry. Let me answer the questions first in the chat. There's one for AMD. Is lower PATME in FY22 and 23 good when compared to FY20 and 21? How is this metric different from EBITDA and which is a better KPI? So yeah, in general, lower PATME is not good, but in this case, we think it's still understandable because it is still in the transitioning process of integrating with the acquired companies. So yeah, but if you talk about EBITDA is if you talk about EBITDA essentially adjusts for the numbers that are quite unpredictable, such as their interest expense and tax and depreciation amortization. So if we take a look at the EBITDA of AMD over the past few years, it's actually been relatively flat, including in FY22. So that gives us a bit of a good, which means that the underlying business is not hurt. So in terms of which KPI is better, we would still prefer to use PATME because AMD has been profitable for quite a long time. So if let's say they suddenly turn to loss making, it's quite a worrying sign. Unless it's marginal or it's because of the integration following some acquisitions like they did last year. So, but then with regards to EBITDA, it is usually used to compare companies that are still loss-making first, or it is used to compare companies with a varying capital structure or different investments that they make. So yeah, for us, we still use PATME on AMD because, like as I mentioned, they have been profitable for quite a long time. So yeah, hope that answers your question. And Zain, I hand the time over to you. Thanks.
Okay, thanks, Max. I'll begin with the TA, so I'll do it in chronological order. Let me just share my screen right now. Okay, so first up is DBS. So in terms of price action wise, wasn't very good last week because for a while we were holding up at around this $31.30 level, which was a breakout above this level. Also supported by this trend line. But last week, I think Wednesday onwards, we broke down of this support. So currently looks like we are retesting the key support around the $30.40 area over here. So if this still holds, we could be trading in this big range over here. But if we do break down this level, then that will be some caution will be warranted in the short term for DBS. Yeah. Okay, then in terms of UOB. Okay, UOB also similar thing. We broke below this trendline support over here. Also, the swing lows around $27.60 over here also broke down. So in the short term wise, I think currently we tested this swing low around 27.38 over here. If this holds, we could see some potential short term rebound to retest this support that was broken. Yeah, then but for now it's still looking a bit bearish since that there's actually some breakdowns taking place and lower highs trading over here. And I'll cover the last one, OCBC. OCBC also not looking very good for the time being. So we actually broke below this support around 12.15 over here. Currently, there was a retest today. So for now, it will be key to see whether the price actually managed to enter back into this range, where the next resistance will likely be around 12.25, this swing low over here. If not, then we could see continuation of the downside momentum possibly. Then the next support after $12 would likely could be around 11.80 over here if we do see continuation of the bearish momentum. Okay, so that's for the three banks. And I'll move on to Capital. So for Capital, Capital, we weren't able to hold this swing low upon the second retest at around 6.55. So price actually broke down over here. Currently, I think still holding up around this level around 6.40 based on the previous short-term resistance range breakout over here. So if we can't hold this level, the next support would likely to be between this next swing around close to 6.20 to about 6.30 over here. That will be a stronger support for Capital if we do see price continue to go downwards. Then in terms of the MACD wise, we see there was a higher high made in terms of price. There was a lower high made. So there's looks like some bearish divergence is currently reflecting in terms of the price action over here right now as well. And Wilmar next one. Wilmar also currently price has been trending downwards. Currently looks like a short-term rebound after hitting about 360. But there could be some immediate resistance ahead based on this trend line over here. That's around close to 373, which is this short-term swing high over here. And it was a previous support also. So that could act as a resistance in the near term. If Wilmar doesn't, if it doesn't manage to form a higher low over here in the short term, then the downtrend could possibly continue to maybe close out this gap around 354 around here. That could be a next level of support if price continues to trend downwards. Okay, next one is CICT. CICT looking a bit bearish last week also. So we broke down this support line, uptrend support line over here. Then price tag onto this downwards trending trend line support over here around 186. So for now, let's see whether it's able to hold at this price for a short-term rebound, but still lower highs being made along the way over here. So still some bearish price action for CICT. The next one will be 9868 Xpeng Inc. So Xpeng bullish. So there was a breakout of this very long range consolidation over here. So price I think just for now is consolidating the range for now. Volume has been tapering off. So if we do see, I think if we do see a retest of the recent highs around $50.40 close to this level, there should be some near-term support over here. Then while resistance is around $59 for time being. So I think for now, price are actually be doing some slight consolidation from this recent bullish movement. Then the next one will be 579, Beijing Jingneng Clean Energy Company. So for this, I think currently it's very in the big picture wise, it looks like a descending triangle being formed. Price currently retesting the support around 169 over here. But something to take note is that there's quite a range being formed over here between 169 to about 177. So I think should the support hold, I think price could rebound possibly to continue in this range over here. But if it doesn't hold, then we could possibly head down to test next supports around closer to 157, 158. Since in the midterm wise, we are seeing lower highs being formed into the support, which is a bit of a sign of weakness. Yeah. Okay, next one will be LHN. LHN managed to break above the 37.5 cents resistance level, and we hit about 39.5 cents. That could mean this trend line resistance over here as well. So for now, price might do a bit of a consolidation if the resistance holds at this level, then short-term support will be this breakout at around 37 to 37.5 cents over here. Something to take note on MACD, lower high being formed, while price is making higher high. So that could signify some momentum is not being accompanied with the increase in price. So if there's no follow through, then that will be a bit of a caution for LHN. But if price managed to follow upwards to break new highs, then the next resistance could be at around the previous swing high from 41 cents to about 43 cents over here. And the next one will be Prime USD. So for Prime, I think currently we are still seeing range consolidation. The resistance at 23 cents is still acting over here, but looks like there's a break. There's price action wise has gotten out of this blue color trend line over here. If you're able to hold around 21 cents to form a higher low, higher than this swing low over here, then potentially there could be some reversal taking place. If you do break above the 23 cents resistance again, then the next resistance will likely be at 25 cents over here. Okay, next one will be Keppel Pacific Oak. In terms of Keppel Pacific Oak, currently price retested the swing high over here around 34 cents. So short term wise, it could be some resistance acting on it. The next resistance level is also quite near, which is around 35.5 cents, previous range support over here. So I think short term wise, price may actually just consolidate in the over here since there's some near term resistance ahead. Support wise, still looking okay, around 32 cents, higher low being formed, and MACD also trending upwards. So if there are lower highs actually being supported, then it's still looking better for Keppel Pacific Oak. Okay, then there's a question on STI. So I'll look at the index. Okay, STI wise, so I have a few trend lines over here. The first one, okay, I'll look at the short term. This orange trend line support we actually broke down last Thursday. Then secondly, this black color trend line support. Yeah, I'll go into the weekly time frame. So this is quite a key support over here. We've seen it. The index bounced a few times over here, but there was a break last week. So even if the index cannot recover back above, then there will be some bearishness to be expected. Especially since there's some lower highs since the start of this year going into this trend line support. And so for STI wise, looking a bit bearish for now. The next one is Food Empire. Okay, for Food Empire wise, I think for now it looks like it's trying to break this resistance at $1.06. So the good thing is that upon the retest over here, it has been forming higher lows, and MACD has gotten back above the zero line and positive crossover. So with that, there's actually a chance. I think there's a chance of price trading higher if there's a successful break to try and retest this resistance zone around 110 to 113 over here. Yeah. And then next one is Genting Sing. Genting Sing, I think possibly price retested the swing low around 92.5 cents over here. Could be possibly consolidating in the wedge over here for now. Then yeah, especially given the low volume, looks like some consolidation taking place. So for now, I think I expect price to actually just consolidate further in this zone over here, which is around the swing low around 19.5 cents to some short-term resistance at 94.5 cents. Okay, then for Seatrium currently price is still holding up in a bit of a range at this this channel support over here, the uptrend channel support. So I think for now, if you want more price action in terms of breakup, you need to see price break above this 12.8 cents resistance, which was this short-term support being broken over here. So for now, I think price will try to consolidate still, unless there's a break upwards or a break downward below the recent swing lows of 12.3. Then if not, that we will likely still consolidate in a range for now. Okay, then in terms of sets wise, I think sets is price has been flattening over here. So I think the downwards momentum for now has ceased. Then there's a recent try to break above this resistance on 262. If price is able to hold up over here at this range resistance, then there could be a chance that there's a short-term bounce to maybe 270, which is this trend line resistance over here. And the next one is some Hong Kong counters 3032 Hang Seng Investment Management Tech Index ETF. So for this, I think currently looks like there was a retest of the swing low last week around 381 price bounce from here. So if we continue if we sustain this bounce, there could be a retest of around 403 over here, this swing high. Yeah. So for now, but it still looks like a bit of a range consolidation still for this ETF over here. And for Tencent also the support over here around the 325 to 330 area is still holding up. Price went back above over here, so there could be some bounce to try and test the resistance at 340 over here for Tencent in the short term if this holds up. If not, then the downtrend over here could continue. Then we test the next lows around 310 over here. The 9618 JD.com. For JD currently, I think price is still holding up at this channel support over here, and recent swing lows around 130. So for now, could see some bounce to try and retest a recent resistance, which is around 140 to about 145 over here. Okay, then the last one will be Ping An Insurance. Ping An Insurance currently retested this for the 850 support over here. But in terms of price action wise, today didn't open higher, but price is currently trending down again. So need to see this level hold. If not, we could test swing low around 47 over here again. If this holds, then we're likely to see, similar to the other Hong Kong counters, could see some bounce to test the recent swing high resistance around $51 over here. Okay, then there's a question from Kayla about Tesla. How do you see Tesla shares heading ahead of its earnings release? It's a good support around 220. For now, Tesla, I think in terms of the midterm trend wise, it's still very positive. It's still trading above the 20 MA. There was a rebound recently, and price actually just retested. There was a high around 275. But in terms of how I see trading for now, there's some short-term resistance ahead. So I think first up is this I zoom out, there's this blue color trend line resistance. So it has been acted on 3 times, possibly around 288 to 290 over here. Yeah. Then in terms of the price action wise, currently still holding up above the recent highs around 275 over here, just trading in the range. But in terms of the MACD wise, to see lower high being formed, and this is a failed crossover. If the price actually continues to trade higher, then possibly there's some divergence, bearish divergence taking place if there's a there's a confirmation break above this recent support. Then maybe there could be a retest of this recent resistance form close to 260, then there could be some support over here. Yeah. So I think Tesla for a short time, I think that it wouldn't hit to as high chance, I think wouldn't hit towards 220, which is rather lower previous resistance. But for now, I think some support, it could go and maybe retest some near-term support around 260 or a lower wise, maybe 240 ahead of earnings, which you mentioned is 19 July, about over a week's time. Yeah. So that's my view for Tesla. And then there's a question in TA, what is a golden cross? So golden cross refers to a signal where the 50-day moving average crosses above the 200-day moving average. So usually it's quite rare and it's usually used by technical analysis to see what's the possible change over in trend in terms of the midterm trend being more bullish than a long-term trend. So usually about 70% of the time in terms of when you're looking at the S&P 500, when it happens, there are usually some gains for the index in about 6 months following this signal. So usually some people will look at golden cross before they want to enter a position for midterm. Okay, hi Zane, is price action and trends method more superior than other schools of thought, which is the indicator and wave method? And Fibonacci is just a mere coincidence and used to predict the share price. Can you also highlight what's the pitfalls for each school of thought? Take note. Okay, so I'll answer part by part. So is price action and trends method more superior? I think it really depends on individual, but in terms of myself and I think most of the traders, I think they will prefer to look at price action since it's the most up-to-date kind of inverted comma indicator that you can have to study in terms of the trend. So price action will actually and volume actually form the trend. So and people always like to trade with the trend. So definitely, I think for myself, these two are definitely more superior than other indicators. Indicator is a bit lagging in terms of some of the indicators out there like MACD, moving average, since they actually need to compute the past data to give you the current value you are seeing day to day. So, but they still work in a way. It's still good to actually confirm your thesis in terms of bull or bear. And wave method is more useful in terms of long term. The Elliott wave method 1, 2, 3, 4, 5. Yeah. To also confirm a trend. Fibonacci wise, I think it's a little bit less useful. I think could be, you can say it's a bit more of a mere coincidence since it's a sort of a psychological kind of indicator where you just pull out the indicator and confirm whether price actually retrace to a certain kind of desired area like 50 to 61% retracement before you consider take on kind of pullback trades. Yeah. Then pitfalls for each school of thought. Price action wise, I think you need sort of confirmation. So let me plot an example like OCBC in this case. So over here, there's a range breakout that takes place, right? So with this bullish candle increase in volume, but let's say price action wise, you need to look for, the most important thing to look for is follow through. So there's a back test over here, but subsequently it wasn't able to maintain above this breakout. So price action wise, you need to take note of this possible shortfall where doesn't necessarily mean there's a breakout and means that price will actually trade higher. So you need to look out in terms of follow through. Then MACD wise, moving average, all those is lagging in terms of how the indicator is actually computed. Then Fibonacci, yeah, a bit of a coincidence, not really useful for all kinds of stocks. Yeah, so that's my view on your questions. Hope it answers your queries. Things. Okay, TA for HST. I think HST might be similar to the 3032 earlier, which is the Huntington Investment Management ETF. I think for now could be maybe consolidation for now for this since price in terms of higher lows being formed but lower highs. So in terms of price action wise could be consolidating for a move upwards or downwards. We will see in the near term. Okay, then Hong Kong land, for now still very bearish. Price has actually been trending downwards. After last week, it looked like we broke a lower low below 390 over here. We tested the next swing low around 378 over here. Then you look at MACD wise, still very bearish, negative crossover all the way. So for now, still no confirmation of a reversal. I think let's see whether the next support's around close to 370. So let's see whether how price action is there reacts over there. Yeah. For now, looks like hit a temporary support around 378. Okay, then DFI currently looks like a retest taking place. So previous support around 280 was broken, and it was a retest after price managed to find some support based on this previous resistance around 258. So there's a retest taking place. So I think for now, if price is able to trade higher, the next short-term resistance likely to be between around 289 with this swing high over here. Then see whether price can form a higher low, possibly if there's a reversal to take place. But for now, looks like just a retest taking place in my opinion. And next one is Jardine CNC. Okay, so Jardine CNC, currently I think still consolidation. Short-term wise could be breaking down of a very short-term uptrend support line over here, but need to see, but for confirmation, still need to see whether this low at 33.10 this is being breached. If not, I think still likely to trade in a range unless this is being breached. Then resistance still holding up over here, still the same around 34.50. Okay, please explain in a nutshell what is wave theory. So, okay, wave theory. Okay, so let me pull out an example. Okay, so wave theory suggests that for a main trend to form, there's actually a 5-wave pattern that has to take place. So for example, HSI, so we know there was a pullback since January this year. So for example, in this downwards trend wave, likely there's a 5-wave pattern being formed. So there will usually be a first wave of drop, then there's a rebound, which actually is wave 2. It actually forms a lower high or a higher low. Then it depends on whether you're looking at uptrend or downtrend. Then there will be the main wave, which is called wave 3. And so whether there's a big drop or a big rise, and there's a wave 4 retracement again, and the last wave is the conclusion of the trend. So for now, this is like a 5-wave downtrend taking place for HSI this year. Yeah, so this is just an example. Then usually after the 5-wave, there will be a corrective wave, is called ABC. So usually we'll see a counter trend correction taking place. So for example, ABC taking place over here. Yeah. Then before there's a possible continuation of the main trend if that happens. Yeah. So this is just an example for anyway. If you can look up more, I think if you look at Google, some of them give quite good explanations. Yeah, if you're interested. Okay, next one, Raffles Medical. Okay, Raffles Medical, currently, I think price, last week we broke above this range at 136 and we tested this 141 over here, which was this uptrend support line previously broken down. So, and also there was some previous swing low over here we tested, now acting as resistance. So for now, I think price just back testing this trend line. If we are able to hold at these levels, form a higher low, then possibly price could do a rebound over here for Raffles Medical. Okay, then there's a question, is is RSI less lagging? Actually depends on, I think there's a feedback, there's a comment made by an attendee in the chat. RSI is less lagging than MACD, but if you just use RSI alone, you might get a whipsaw trading range. So definitely look out for bullish divergence, golden crosses for confirmation. I agree with his or her views. Yeah, and RSI depends on the kind of indicator you use, the time frame. So yeah, RSI, for example, you can look at the length. The length is actually quite important. So usually people look at 14 days. So even more reactive, you can look at maybe 10 or even lesser, but longer wise maybe 20, but usually people look at 14. So it depends on how lagging is, and sensitive actually depends on the length of the indicator actually select. Then RSI is less helpful if in a sense that if doesn't mean overbought or oversold, means that the trend will actually change. So it just means the strength of a trend. So and then below or above 50 actually signals between the bullish and the bearish territory. So also more of a confirmation kind of indicator. And as what the user suggest, as what another attendee suggested, I think it makes sense to actually combine with many different other indicators, look for more confirmation. Yeah. Okay, I think last question I'll take is two counters on AEM and Yangzijiang. So first one, AEM. Okay, for AEM wise, I think after we tested this blue color channels resistance around 390, price retracing over here again. So for now, there could be there's a possible support zone around 370 based on this previous resistance. So see whether price is able to hold up at this level. If not, we could possibly go and retest maybe these recent lows. I think will act as a good support around 350, 353 to about 350, around 358 over here. Yeah, but for now, looks like a short-term pullback taking place for EM, since the volume actually tapering off over here as well. Then in terms of Yangzijiang, I think bullish movement recently also broke above the all-time highs over here. So I think for now could be consolidation in a possible bullish flag. Volume has also been tapering, also signals some consolidation taking place. So need some confirmation to the upside or downside to see for the next trend direction to form for Yangzijiang, I think. Yeah, so I think that's all for me today. I'll hand over my time to my colleagues for other questions. Thanks.
Thanks, Zane. I'll take over from here. Okay, there's a question in the Q&A. When is Singapore announcing June GDP? Oh, this question is easy. Is this Saturday, 8 a.m.? They will announce the second quarter GDP for Singapore. Okay, then another question in the chat. What's your view on Sembcorp industry last week? I think he's asking about fundamentals. Yeah. Last week there was a downgrade by another analyst on Sembcorp Industries. We are keeping to our target price of $5.06. Yeah, this is below the current market price. There's a possibility of an first thing first, the results will be coming out. First half results will be out on the 4th of August, early in the morning. We expect it to be a decline, year-on-year decline, because last year, first half they benefited from the jump up in the spot price for energy. As you know, Sembcorp Industries is a power play. It's 80% of their earnings are really from energy, and Singapore forms the bulk of it. So last year, first half, they had benefited from a jump in spot energy prices. But this year, first half, other than the month of May, on a year-on-year basis, the USEP, the Uniform and Singapore Energy Price is actually on a downward trend. So therefore, expect the first half earnings to be a decline year-on-year. But there is still a possibility of a Sembcorp announcing their latest progress on their renewable energy capacity. We're waiting for that to be announced soon, where they will give us an update on what is the current renewable capacity, because most of the renewable capacities that they invested in are either greenfield or brownfield. So as they complete the construction, then they be able to bring this on board. They will update us on what's the operating capacity. Then we will, from then on, we might be able to upgrade our earnings forecast going forward. Maybe not this year, might be from FY24 onwards. So there's a potential for an upward revision in our target price. But given what we have currently right now, in the information available, we're still sticking to our target price of $5.06. And over these 2 weeks, we see some other we'll see some earnings preview for the first half results to be out, which will probably not positive for the share price. Thanks. I hope I've answered the question. I don't see any more questions in the chat. Darren, when I pass it to Paul? Yeah, thanks.
Yeah, okay. Thanks, Mac. So, just to follow up on the US Asian hours, the commission is 8 basis points or 0.08% promo up to September. Then after that, it will revert back to 30 basis points. The stocks are all traded in US dollars, so there shouldn't be any FX risk. I mean, if that was the real question, I thought it was something else. Okay, let me just answer this last one. How do you see the 30 billion loss by MAS due to stronger currency, and what effects would this have on the market and higher chance of a default government debt? Okay, so thanks for that. I was hoping not to get this question, but so the MAS 30 billion loss, 21 billion of it came from translation of the foreign reserves. So MAS has about, if you do a weighted average, about 500 billion Sing dollar of foreign currency. And if you take that 21 billion translation loss, so you're talking about maybe 4% translation loss, which is roughly because they never say how much is US dollar, so which is more or less in line, because it depends when the money came in, but the US dollar for that year was down about, for that period till March, was down about 2%, euro about 3%. But again, it depends on timing when they get most of these inflows. And a lot of the Asian currencies were down, or yen was down as much as 10%. So it looks reasonable, the loss, because of the FX that they hold. I mean, you're talking about 500 billion. The irony of it, if MAS were to report this in US dollar, maybe they wouldn't have reported such a huge loss, because they have to report in Sing dollar how much foreign currency they own. The effects on the market, not really. The irony of this is that you get this loss is when the Sing dollar is strong. So in a way, it's also a good thing, because Sing dollar is strong, just that MAS is holding all these foreign currencies, so they get hit by it. And the liquidity coming in is always a positive for our currency and the local liquidity. Higher chance of default government? No, because most of our government debt is all in Sing dollar, so we can issue as much as we want. I mean, theoretically, so I don't think it will be that drastic. It's just most of it was a currency translation loss because of the foreign currencies that they own. Okay, I think with that, thanks for the question. I think with that, we can end the session. I'd like to thank everyone for your time. Hope to see you in our US strategy and also in our Singapore strategy. There's also a 1 PM Malaysian strategy if anyone's interested. You just have to go to the POEMS website and register. With that, I'd like to thank everyone for your time, and thanks for your questions, and I hope you have a good week ahead. See you and take care, everyone. Bye-bye.